Welcome to PIMCO Pod. In this episode, we discuss how BDC equities continue to trade at significant discounts to NAV, reflecting skepticism toward reported marks, a concern reinforced by valuation levels that have yet to fully reset, even as BDC bonds continue to outperform their stocks. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens, What BDC Markets Are Signaling About Private Credit Valuations by Lotfi Karui. The performance across the capital structure of BDCs, funds that invest in small and mid-sized private U.S. businesses, continues to diverge, with their bonds outperforming and equities lagging. What explains this gap? The simplest answer is an asset valuation story. Credit investors have recourse to the assets against which they lend, while equity investors are increasingly focused on the credibility of reported net asset values, NAVs. Equity investors are essentially demanding more risk premium as compensation for the uncertainty around the true marks of portfolio holdings, and this skepticism is unlikely to abate without a better price discovery mechanism. Indeed, in our view, the true valuation reset has yet to begin in earnest. More than 2 quarters after redemption pressures began to weigh on semi-liquid, direct lending vehicles, and despite a growing number of signs of financial distress across parts of the market, BDC portfolios show little evidence of a meaningful valuation reset. Loan marks remain elevated, both in absolute terms and relative to the broadly syndicated loan, BSL market. If anything, the gap appears to be widening, comparing the 25th percentile of BSL prices with BDC portfolio valuations over time. While similar divergences emerge during periods of acute stress, such as the COVID-19 shock or the 2022 Russia-Ukraine war and subsequent hiking cycle, the current episode is unfolding against a backdrop of relatively more benign market conditions and low levels of systemic stress. The challenge for BDCs extends beyond elevated marks on existing loans. The incremental yield advantage available in new direct lending transactions has also compressed substantially. Deals originated in 2017 and 2018 offered BDCs an average spread pickup of more than 300 basis points, BPS, over leveraged loans. By the first quarter of 2026, the most recent period for which filings are available, that advantage had fallen to less than 100 basis points. In other words, while existing portfolios continue to be carried at elevated valuations, the economics of deploying new capital have become increasingly less differentiated from those available in public credit markets. Where might this divergence between public market pricing and BDC marks lead? The recent experience of private real estate offers a useful, albeit imperfect, precedent. During the 2022 dislocation, private real estate vehicles initially resisted the decline seen in publicly traded REITs, only for valuations to converge later through a combination of public market recovery and private market markdowns. A similar outcome cannot be ruled out for BDCs. That said, the adjustment process is likely to be slower, given the support provided by bank credit facilities, ongoing principal repayments, and the presence of liquid assets that can be sold to meet cash needs. Nevertheless, if marks ultimately need to move closer to where comparable risk trades in public markets, the potential for further valuation pressure on BDC equity remains a meaningful risk. Thank you for listening. That was the Credit Market Lens. What BDC markets are signaling about private credit valuations. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.